Goldman Sachs reported, and this is coming off of JP Morgan, which wasn't that pretty, but Goldman Sachs missed by a mile. The largest miss in over a decade. Okay, looked it up. I've never seen them miss by that much. They usually, they're always beating by like a ton. Trading revenue and all this stuff. And Morgan Stanley was good. It wasn't great. It was mostly in line, a little bit of a beat, but it just made the Goldman Sachs numbers look so much more terrible. And it was interesting because it's a trend that I told you about probably started 6 months ago. I said, we're in a market where we're not going to see everything where it's a bull market, everything goes higher. Just like a bear market, everything goes lower. We're in a market where management teams matter, earnings matter, operations matter, right? Because it's going to be hard to grow top line. It's going to be hard to even grow bottom line. You got to cut costs and things like that. So management teams are critical. But this is going to be the first time you see in probably 12 years where there's going to be companies within a sector that do well and others not do well. Where we've always seen, listen, you see Salesforce.com go up a lot higher than some other, software companies, but they'd all really go up. But now you've seen today right now, Goldman Sachs is down 6%. I'm doing this midday. Is down 6% while Morgan Stanley's up 7%. They both reported today, right? So you're seeing the separation within industry leaders, 1 and 2. And you'll see Home Depot and Lowe's and Target and Walmart. But a lot of times you'll see, 3-4%. You don't see a move like this in the same day that they report. Like, it's very rare to see something like that far, that wide of a gap, that kind of discrepancy. But it just shows you, Morgan Stanley was okay, but Goldman Sachs, looking through the quarter, it was bad even though they laid off 6% of their workforce. Now, I'm going to get to a very important point here you need to understand. Because what they said is 2023 looks uncertain. Uncertainty is a death of stocks. I tell you that all the time. When you're uncertain, you don't know whether to buy, you don't know what's going on. That's why we're trying to figure out how far the Fed's going to raise, how far they're going to go. And we still don't know, because if the market holds up like this and we continue to see this rally, they're going to go into the summer and continue to raise, because the Fed doesn't want to see this. They want to see the market really, really pull back. We're seeing inflation trend in the right direction, but it's not down tremendously off its highs, right? It's trending in the right direction. It's still very, very high. The bills you're not noticing outside of gasoline that you're like, holy shit, man, my bills are so much lower now. Gasoline you're noticing, but you're not noticing anything else. Food, electricity, a lot of other things that you pay for. Insurance, house insurance, auto insurance, and things like that, you're not noticing. Right? You're not seeing it to the point you're like, wow, this is great. Inflation's coming down. I feel better. No, you're still not seeing it. It's still very high. But they said underwriting is extremely muted and seeing early signs of credit deteriorations. That's very, very important. And you need to understand that. Because if you're seeing credit deterioration now, what do you think it's going to look like over the next 6 to 12 months? We have the Fed is going to continue to raise rates at least through March, but if the market does hold up here, they're going to keep going. They're going to keep raising. They're not going to stop raising and watch the market go up 15, 20% if they stop. They're not going to see that. No way. It's the last thing that they want. They made it very clear. We do not want to be early on this. We don't want to stop early. And they're not. Which means for those of you who think that, the pausing, fine, you have an argument. It could be March, April, May, June, July, and go a little further, maybe into the fall, who knows. For people saying that the Fed's going to cut rates this year, they're out of their mind unless we see a dramatic collapse in the markets. It's not going to happen. It's not going to happen. So it means rates are going to remain relatively high. And also you throw in QT, quantitative tightening, where the Fed's shrinking its balance sheet by hundreds of billions of dollars every quarter, removing money, which means market conditions are going to continue to deteriorate. Demand, you're going to continue to see that destruction. So, like I said, while inflation remains pretty elevated for most families and their bills are still high, yeah, it's tough to see, even with inflation moderating, that we're going to go back and say the Fed's going to be like, oh, okay, well, we're done. Okay, we're good. Don't worry about QT. We're not shrinking our balance sheet anymore, which they said they're going to shrink probably for the next 18 months. They have to take that money off of their balance sheet. And then you're looking at rates going to stay relatively high. And yeah, they're pulling back a little bit, and you're seeing mortgage rates pull, but they're much, 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 much higher. You're not seeing the housing market take off because mortgage rates went from 7% to wherever they are, 5.8, 5.9, around there. You're not seeing, oh my God, well, demand's coming back to the market. No, they were below 3% in January. So the housing market, you want to talk about frozen. Holy cow. And even in Florida, and Florida's supposed to be a great market, right? I live here. I own 3 houses here, but I'm trying to sell one of them right now and having trouble selling it. Not even like an offer. And again, it's January. It's not you go into late February, March, April. That's great for Florida. You see houses really fly, off the shelves here. But we'll see. But right now, usually it didn't matter. It was a couple of weeks. It's been on the market probably for 3 weeks. I haven't gotten an offer. And it's in line with everything. I'm not trying to get, again, not even a low ball offer. No matter what the price is, someone's not coming in much, much lower, which I'm surprised. But you're seeing it. You're seeing everywhere. And I'm hearing that from real estate agents that, it's going to deteriorate even more. It's going to get worse before it gets better. Now, when I look at Morgan Stanley numbers, a little bit better. Again, I talked about that separation we're seeing within industries the first time in a decade. Like, I can't believe I'm seeing Goldman Sachs down 6%, Morgan Stanley up 7% the same day when they reported. That's pretty cool. But Morgan Stanley, I don't know. I may look to sell here. I mean, they're up, but they even said they expect net interest income to moderate from the pace of the last 2 quarters. So they're predicting slower growth going forward along with most of the banks. Now, with banks, and people want to buy banks, and I made the mistake earlier and we got out of them, which was good. But interest rates rising is supposed to be very, very good for banks, right? Because their net interest margins expand. What they able to lend the money for, again, that margin expands. That's great. That's how banks used to operate forever until about 12 years ago, because we pushed rates to 0. So banks are like, holy shit, we got to find other ways to make money. What do? They had fees everywhere, right? You shook the hand, you waved, and it was a fee at a bank, right? Everybody got fees. But just the investment banking fees have taken off, the trading fees, the fixed income fees are always going to take off because it's an illiquid market, and they use that to their advantage, these banks and investment banks, in terms of trading. But they ramped up their fee-based businesses, their advisory businesses, and there's so many business deals going on. It was crazy, right? They're making a fortune. So while higher rates are good for banks, it crushes everything else they made money on, including advisory fees, those investment banking fees, overall banking fees for the past decade. But more importantly, if you're looking at the banks and what's going on right now, what are they doing? They're ramping up their provisions for credit losses. So they're preparing for potential loan defaults. That's one story in itself. Okay, and some people may say, well, they're being conservative. The banks are being conservative, right? They're just making sure, right? Based on new laws and Dodd-Frank, they're being conservative. This stuff is based on algos. It's based on AI, which tries to take out the guessing. So once things hit and they see certain factors happening, the computer systems are saying, ramp this shit up because we're expecting tougher times. Based on everything we know, putting in all the data points for the last 50 years, 60 years, this is what we know what happens. So it's their algorithms that are telling you. This isn't a guessing game. They're trying to take as much guessing out of it by using AI and using algorithms, right? So they're algorithms. That's why you're seeing all these banks increase these provisions for credit losses. Now, S&P 500 banks reduced their provisions for loan losses significantly in 2021. I mean, 2020, the market did great in 2020. We just had like a month and a half before the Fed said, balls to the wall, 11 trillion, 50% of GDP out there. We're just giving money to everyone. I don't care. Even when the market comes back, we're still giving trillions and trillions and trillions. I always say, to put that in perspective, when you look back at TARP, that would turn out to be $470 billion to save the whole world from a credit crisis, right? The whole world from a credit crisis cost $470 billion. We're throwing trillions around like nothing, right? It's up to $11.5 trillion just in the U.S. That's just the U.S., right? Well over $20 trillion when you look globally. How much money's been injected that's now coming out of this market? But 2021, banks knew, hey, we're seeing great numbers. The algorithms are showing that loan losses are the lowest they've ever been because everybody has money and free checks. Again, this wasn't given to the banks to bypass. The banks got the chance to lend out the money, right? There's like to shore up the banks. Now you bypass everything. You hand the checks directly to businesses and PPP loans to people directly. You have a couple kids. Here's a couple more $1,000 here, there. Everybody has money, right? Everybody's rich, right? Your next door neighbor who held a job for 6 months has like 2 Mercedes in their driveways now, right? That's 2021. So they reduced their provisions to the tune of $27 billion. Now, that's very, very important for you to understand because in 2022, last year, fourth quarter is being reported right now, they've increased these provisions so far, right? 2022, and this is accounting for the estimates and the banks that are already reported, so it's going to be pretty close to this number. They're increasing their provisions by $17 billion in 2022. And this number is likely to go a lot higher in 2023. Now, why is this important? Why am I saying loan loss provisions on a podcast? I mean, you're going to go to sleep, you're going to change the channel, you're going to put something else on. It's important if you want to make money in stocks, which I think you care about, is why you listen to this podcast. Okay, those provisions, they don't impact the top line, which is called the revenue. That's the top line, the revenue and the sales. It destroys the bottom line. And so much so that banks are expected to report this quarter, and it might be lower than this after Goldman Sachs just reported. They're expected to report a 26% decline in earnings year over year. So for this quarter, and you compare it to last year's fourth quarter, a 26% decline in earnings. You know how much that is? A 26% decline in earnings? I mean, that is massive. It's massive. So you're looking at decline in earnings per share. So when you see banks coming down 20, 25% from their highs, you can't go in and say, wow, I think banks are cheap here. Because they're not. Why? Because their earnings are absolutely crashing here. They're revising their models that were fee-based into more net interest income. And you could see it in the results. They're making a fortune. They're making so much money on the net interest margins. But when you're losing all that business that you got from mergers and acquisitions and even trading, which is a little bit less trading now, right? So you're not seeing as much liquidity now with the markets down as much. You're just, again, that merger acquisition, advisory fees, you're seeing the fee business absolutely crash here. And that's what's hurting these guys. But not only that, they're seeing their provisions, those loan loss provisions, go higher and higher and higher. And as they do that, that comes directly from the bottom line. So when you're looking at banks and their earnings declining 25%, you can't say, well, these things are really cheap here because their earnings are crashing alongside it. And I try to explain this to you because I try to educate as much as I can. But a stock can go up 100%. You might think you missed it, but it may be cheaper after it went up 100% because earnings exploded higher. But a stock can also be more expensive after it declines 30%, if earnings are crashing like they are with the banks, right? It's clearly the case with the banks right here, especially with Goldman Sachs, who never misses. Goldman Sachs, we had that in the portfolio forever. I forgot what the percentage. We did very well on it. We had it for a long time. We're up a lot more, and it came down a little bit, but still, we locked in really, really good gains for Goldman Sachs. They rarely miss. Okay, just the trading fees and everything, low interest rates, they're the best of the best, right? So we all hate them, but we all kind of want to work for them because we can make a lot of money working for them. But they reported their biggest miss in earnings. They missed by the most they missed in over a decade. And I'm not sure how it's going to get better. With provisions for loan losses, they're going to increase for these banks significantly. Why? Because the markets and the conditions are deteriorating. And why many of their growth engines, you look at their growth engines, underwriting, advisory, trading, they're going to continue to be out of favor for at least the next 2 to 3 quarters at least. So be careful buying the banks here. It's not like, wow, good time to buy Goldman Sachs. It's down. Listen, I've owned Goldman Sachs for a very long time in our portfolio. And we don't own it anymore. But I can't see owning it even now, even on this pullback, or Morgan Stanley, who basically warned that, hey, the next quarter is going to be a lot worse than the previous two. It just, when you compare it to Goldman Sachs, it looks that much better. It's probably why it's up 7%. So you might be better off buying puts on that or stuff like that, maybe, over the next couple of quarters. But man, when I'm looking at these numbers, it's insane. It's just insane. When you see the headwinds, when you see what's going on with the Fed, when you see that it's going to continue, you're going to see demand destruction constantly, money shrink in people's bank accounts. You're going to continue to see that as conditions get worse. I can't see you owning the banks here. It just doesn't make sense, especially while their earnings are absolutely crashing and those loan loss provisions are going to go up a lot more next year, much more. Again, they lowered them by $27 billion in 2021. They're going to be up $17 billion. Do you think they're going to go much higher from here? I think they could be $25 billion next year. If they are, it's going to be hard for these companies to beat earnings. It crushes their earnings when they raise these provisions. It comes directly from the bottom line. Something you need to note about when they're going into earnings. It's going to be very difficult for banks to beat earnings if they continue to increase those loan loss provisions, which they were doing, and it's why Bank of America missed. I think you had one of the Bank of America was okay. I think JP Morgan missed, but you're seeing companies that the JP Morgans and Goldman Sachs almost never miss, and you're seeing them miss. And this is a big reason why. And that is not going to change going forward.